Gold just jumped the fence again, and silver didn't calmly follow. Silver flinched like it knows what's coming. That's what happened. Gold pushed higher. The crowd stared at the gold chart, and silver started waking up in the background. This is us right here, right now. Let's move. Because the biggest mistake we can make is thinking silver is a slow story. It's not. Silver is the fast horse tied to a bigger animal. And when that bigger animal runs, the fast horse doesn't jog. It bolts. Now here's the part they don't say out loud. They want you to believe silver is boring. They want you to believe silver is stuck. They want you to believe it's dead money until some magical crisis appears on the news. That's how they keep you passive. But markets don't wait for your permission. Markets move when pressure builds, and pressure is building in the one place most people ignore. The structure of gold demand. Not doom. Not the dollar dies tomorrow. Something colder. Something more realistic. Gold is what countries buy when they don't trust each other. Gold is what gets stacked when tensions rise and contracts start feeling fragile. Gold is the reserve you hold when you're not sure the phone lines will stay friendly. Call it war insurance. Call it strategic paranoia. Call it what it is, a bid that doesn't care about your feelings. When that bid is real, it drags the whole metals complex behind it. And that's why we're even talking about silver going to $100, maybe higher. Because silver doesn't need 1,000 different reasons. It needs one big engine pulling it. Gold is that engine. And once gold is moving, silver becomes leverage on the same idea. But let's be honest with ourselves before we get excited. Silver can reward you. Silver can also punish you because leverage cuts both ways. So we don't hype, we measure. We separate facts from interpretation. Fact. Gold has been trending with persistent demand. Interpretation. A C clears throat. Meaningful portion of that demand looks strategic, not just speculative, possible risk. If that strategic bid pauses, silver's fast horse turns into a bucking bronco. So we watch the lead animal, not the noise, not the memes, not the hot takes, gold. Here's why silver reacts so violently when gold keeps climbing. Gold is the stadium. Silver is the small room next door. When money runs into the stadium, you barely feel the draft. When money runs into the small room, the walls shake. And silver's room is small. That's not a slogan. That's market math. There are single companies and equities whose value rivals the value of investable silver in the entire world. So when capital rotates, silver doesn't need everyone. It needs a few big hands to move a little faster. And suddenly the price prints numbers that look unreal. This is why people call silver fast gold. Gold can move and look elegant. Silver moves and looks like a fist fight. Now the trap, most people buy silver for the wrong reason. They buy because a neighbor got rich. They buy because they feel left out. They buy because they want a thrill. And then the first pullback hits and their conviction evaporates. So we set a rule in our house. If you can't say your thesis in one breath, you don't have a thesis. You have a rumor. And rumors don't survive volatility. So let's build a real thesis with clean pieces. Gold leads. Silver is smaller, so it exaggerates the move. And the float matters more than the total supply. That last one is where most people get fooled. They hear there's a lot of gold. They hear there's a lot of silver. And they assume supply is sitting there ready to dump onto the market. But price isn't set by how much exists. Price is set by what can actually trade. That's free float. That's the portion available without months of friction. And free float is the quiet monster because most gold is asleep, vaulted, nationalized, buried, symbolic. Even if the price doubled, a lot of that gold still wouldn't move quickly. Strategic reserves don't flip like day trades, so gold's price can surge without running out of gold. It just has to overwhelm the float. Now do the same thought experiment with silver. Yes, there's silver in antiques. Yes, there's silver in cutlery sets. Yes, there's silver sitting in drawers, pawn shops, estates, and dusty boxes. But can that silver flow into the market tomorrow? Not instantly. It has to be collected. It has to be sold. It has to be refined. It has to be turned into the form buyers want. And that takes time, weeks, months, sometimes longer. So when demand spikes faster than that pipeline, price jumps first and supply responds later. That delay is where the volatility is born. And volatility is where the opportunities and the traps live. Now let's talk about the number that turns rational people into gamblers. $100. $100 is not just a number. It's a psychological cliff. People don't trade numbers. They trade stories. And $100 is a story you can hear from across the room. Now let's talk about the thing that turns a good thesis into a great trade. Timing. Not perfect timing, survivable timing. Because silver doesn't rise like an elevator. Silver rises like a staircase in an earthquake. Up 2 steps, down 1 step, then a sudden jump that feels illegal. That jump is where FOMO enters. And FOMO is not your friend. FOMO is the hand that buys the top and then blames the market. So we watch for the moment the story changes, the moment silver stops being ignored and starts being everywhere. When your barber mentions silver, when your group chat starts sending charts, when every thumbnail has a shocked face and $200 imminent, that's not confirmation, that's danger. And here's a trick we use to stay sane. When price goes vertical, we don't ask how high can it go. We ask how easy will it be to get out if everyone panics? Because liquidity is the oxygen of exits, and near tops, oxygen gets thin. Buyers disappear, spreads widen. Your market order becomes a donation. So we plan exits like engineers, not like gamblers. Trim strength. Keep a core if the trend is intact. But never let a paper gain turn into a life lesson. It's the point where late money shows up. It's the point where headlines get loud. It's the point where everyone suddenly remembers silver exists. And late money does one thing really well. It creates the top. So our job isn't to cheer $100. Our job is to survive the road to $100 without getting hypnotized near the cliff. Here's the mistake most people make near big round numbers. They start thinking about the perfect top. They want the exact highest tick. They want the screenshot. They want the ego. Markets punish ego. Tops aren't a single moment. Tops are a process. They form like a storm, a spike, a fake drop, another spike, a squeeze that feels unstoppable, then a quiet wobble, then the floor disappears. So, we need rules before the adrenaline hits. Here's one. Rule that hurts, but saves capital. Imagine you wake up and your broker accidentally sold your silver position. Same price, same chart, same world. Would you buy it back immediately? If the answer is no, holding it is irrational. Because holding is the same as choosing to buy again every day. That test destroys attachment. It forces us into the present. Now, another rule, if you have to ask, should I buy silver? The answer is probably no. Not because silver is bad, because you're not ready. If you can't explain your downside, you're borrowing someone else's conviction. Borrowed conviction collapses on the first drawdown. A real yes sounds different. A real yes sounds like we see gold in a structural uptrend. We see sovereign demand staying sticky. We see silver's small market creating leverage. And we can survive volatility if we're wrong. That's not hype. That's a plan. Now, the next layer is where the media gets lazy. They keep telling the gold story like it's only inflation, like the only reason gold rises is money printing. Inflation matters, sure, but that's not the cleanest driver right now. The cleaner driver is tension, supply chains, strategic buffers, the future of power. And the future of power is being fought in a place most people don't connect to metals. AI, not cute apps, not marketing, the industrial stack, chips, factories, energy, minerals, logistics. This is where the rivalry tightens. And when rivalry tightens, countries don't wait for the missiles. They build inventory. They stack reserves. They reduce dependence. They get ready. That's why gold is being treated like a strategic asset. Because gold is what you can hold without trusting someone else's promise. And here's the part Wall Street hates to admit. You can fight a retail crowd. You can fade an influencer. You can short a chart pattern. But you can't fight governments when they decide a reserve matters. If a country wants gold in its vault, it doesn't care about your RSI. It ships it, it stores it, and it keeps buying through dips that would shake out normal traders. That's why this move can last longer than people expect. Because it's not a trade, it's a shift in posture. Now, look at the world around us. Cables get cut, sanctions expand, supply chains get rerouted like rivers in a storm, and nobody waits for the big headline to start preparing. Preparation is the headline. So when we see steady accumulation, we don't laugh. We translate it. We say the people with the longest time horizon are paying up for certainty. And when that's true, gold doesn't need permission to reprick. It just does. So the narrative isn't the end of the world. The narrative is the probability of stress is rising. And money responds to probability, not certainty. Now, hold this contradiction in your head because it matters. Governments can massage inflation data. They can spin headlines. They can change the subject. But they can't fake the need for strategic reserves. And they can't outtalk physics. If nations feel risk rising, gold gets bid. And when gold gets bid, silver rides the wake. That's the setup. Now, let's talk about spending without going full apocalypse. Yes, reindustrialization costs money. Yes, AI infrastructure costs money. Yes, building domestic supply chains costs money. And when governments spend at scale, it tends to keep inflation pressure elevated. But there's a difference between printing money and burning it and printing money and building something productive. If print and dump cash into pure consumption, prices jump fast. If you print and invest in production, factories, grids, tools, prices still rise, but capacity also grows. So you might not see 20% inflation. You might see 4% in the headline and 7% in real life. And that's still enough to keep hard assets attractive. So we end up with two engines. That's a trend environment. One more thing, and this is where most people blow it. They confuse a target with a guarantee. A target is a map marker. A guarantee is a fairy tale. So when we say $100, we're not promising anything. We're saying if gold keeps pushing, silver has a lane to run. And when the lane runs out, it doesn't slow down, it snaps. And the snap is where portfolios get shredded in minutes. And if that lane opens, the first warning sign isn't a scary tweet. It's internal weakness. It's silver failing to rally on good gold days. It's silver spiking, then instantly giving it back. It's volume screaming while price stops advancing. That's distribution. That's smart money handing the bag to late money. So, we watch the relationship, not the hype. Gold leads, silver confirms. If silver stops confirming, we tighten up fast. Trends are where gold grinds higher, and trends are where silver eventually snaps higher. Now, what does that mean for targets? This is where we use the certainty ladder. Certain silver can move violently when gold trends. Likely a strong gold leg can pull silver toward $100. Possible momentum can push it beyond $100 into the $120 zone. One risk. Above that, the above. Market can shift from repricing into mania, and mania doesn't follow logic. It follows reflex, leverage, desperation. That's why some people can see $200. Not because it's guaranteed, because blow-offs exist, but after $200, the Y gets thin. And when Y gets thin, tops get close. So we don't marry the trade, we date it, we keep our eyes open, we keep our position size sane, we keep our exits real. Now what do we watch so we don't get chopped up? We watch whether gold continues to behave like a strategic asset, not a crowded trade. We watch whether silver starts printing clean momentum or messy whipsaws. We watch whether physical tightness stays firm or suddenly loosens. We watch whether the headlines turn euphoric because euphoria is the smoke before the fire. And here's the question that exposes the whole game. If silver hits $95 and everyone starts screaming $200 next week, do we buy more or do we ask, who am I trading against right now? Because that moment tells us whether we're the shark or the fish. Now, let's get practical. We are not gambling. We are measuring. So we size positions so a 20% drop doesn't break our sleep. Silver will do 20% drops like it's breathing. So if we can't handle that, we're oversized. We also accept a hard truth. Selling 90% of the move is almost the same money as selling the perfect top, but only if we can execute when emotions get loud, and emotions get loud near $100. That's why we decide rules before the fireworks, because once the fireworks start, the crowd starts pushing, and crowds don't let you think, they make you react. Now let's open a loop you might not be watching yet. The biggest mistake is thinking metals move for one reason. They don't. They move when multiple forces overlap. Right now those forces are stacking. Strategic buying, stress, spending, inflation pressure, and a market structure where silver is the lever. So the real question isn't, can silver go up? The real question is when the crowd finally notices, will we still be early or will we be the exit liquidity? That's the line. That's the whole game. And the next couple of weeks can make that line painfully clear. Because once gold makes a fresh push, silver tends to react late, then violently. The quiet phase is where positions are built. The loud phase is where positions are transferred from patient hands to panicked hands. We don't want to be the panicked hands. We want to be the patient hands. Now, if you're still with us, do this one thing. Hit subscribe. Short clean right now. And I want your brain in the comments, not your emotions. If silver breaks $100, what do you think the market is paying for? Fear or momentum? And if we're wrong, where will it show first? Gold stalling or silver turning into pure whipsaw? Drop your answer because the fast horse is already twitching. And when it finally bolts, most people won't realize what happened until the price is already gone.